Have you ever thought about what actually happens when, the supply of something everyone wants starts to really tighten up? Especially when demand just keeps climbing. Because there's a lot of chatter right now about this potential Bitcoin supply shock, something that could really change the game for Bitcoin's future. Today, we are jumping headfirst into this whole situation with Bitcoin, the supply shrinking, demand growing. Our mission to unpack why so many experts are talking about a supply shock. We'll look at Bitcoin's basic design, who the big players are stacking it up, and importantly, what it all means for you. We've gone through a whole stack of articles, research papers, our own notes, really, to give you the clearest path to understanding what's going on.
Yeah, and just to set the scene properly, it's worth understanding what we mean by a supply shock in, like, any market. Basically, it's when the stuff available to buy just becomes too scarce for everyone who wants it. And that scarcity, well, it can really kick off some sharp price moves. With Bitcoin, the data suggests this isn't just theory. It looks like it's actually happening right now.
Okay, let's get into that. So what is it about Bitcoin itself, its fundamental design, that even makes a supply shock possible? I mean, it's not like someone can just decide to print more.
Exactly. That's the core of it. Bitcoin has this hard-coded limit, a hard cap of 21 million coins. And by now, 2025, that's not some far-off idea. It's a real market factor. Just to give you an idea, something like 93% of all the Bitcoin that will ever exist has already been mined.
93%, wow.
Yeah. And then there's the halving. The network's fourth halving just happened in April this year. This thing happens roughly every 4 years, and it cuts the reward for miners, the people creating new Bitcoin, right in half. So it went from 6.25 Bitcoin per block down to 3.125.
Okay, so half the reward means half the amount of new Bitcoin hitting the market.
Pretty much.
Yeah.
Significantly fewer new coins entering circulation every day. After this last halving in April 2024, Bitcoin's inflation rate actually dropped below 1% a year. Think about that. Less than 1%. That makes it, objectively, one of the scarcest assets out there.
So with new supply tightening up like that, like never before, really, how does that change the whole value proposition for Bitcoin?
Well, it hammers home that verifiable scarcity. Unlike, regular currencies where governments can print more whenever, the coin supply is fixed and predictable. The scarcity isn't just a technical feature. It's really the engine behind its value. It sets it apart.
Okay, that makes sense. But the story gets even more interesting, doesn't it? Because even the Bitcoin that is already out there mined,
No.
a huge chunk of it just isn't moving. Why are so many people, these long-term holders, just sitting tight?
Yeah.
What does that mean for the market?
You're right. That's a crucial piece. A really big portion of existing Bitcoin is just unavailable. It's not being traded. You have these long-term holders, sometimes called OTLers in the crypto world, just holding on for the long haul. And the data backs this up strongly. Get this, around 70%, 70 of the total Bitcoin supply hasn't moved in at least a year.
70%, that's a lot.
It is. It's a huge indicator that liquidity, the amount easily available to trade, is really drying up. A lot of this is probably held in cold storage, which means it's offline, not on an exchange. It could be in secure vaults, institutional custody, maybe some's even lost forever. We just don't know for sure about all of it.
Like digital cash under the mattress, sort of. Safe, but not circulating.
Exactly. And this leads to what people call a liquidity crunch. When the tradable supply gets really thin, it can, make trading harder, less efficient.
Yeah.
And we're seeing signs of this on the exchanges themselves. As of early June 2025, the share of Bitcoin actually on exchanges dipped below 11% of the total supply.
Wow, only 11% on exchanges.
Lowest level since early 2018. That creates what's called a dry market, which means even moderately sized buy or sell orders can cause pretty big price swings. It gets more volatile.
Okay, so shrinking new supply, and a lot of the existing supply is locked down or not moving. That definitely paints a picture of a supply squeeze. But then, on the other side of the coin, pardon the pun, we're seeing some absolutely massive players stepping in, right? This isn't just like small-time investors anymore.
Oh, absolutely not. We're seeing a major shift. Bitcoin is really moving from being mostly retail-driven speculation to becoming a serious institutional-grade asset. A huge catalyst was the launch of spot Bitcoin ETFs, exchange-traded funds in the U.S. and elsewhere. These basically threw open the doors for the big financial players, pension funds, banks, massive investment firms.
Can you give an example of that impact?
Sure. Look at BlackRock's iShares Bitcoin Trust, IBIT. In late May 2025, it was averaging something like $430 million in net inflows every single day, per day. That added up to over $6.3 billion in inflows just for that 1 month, May. And when institutions buy through these ETFs, that Bitcoin often gets whisked away into secure, long-term cold storage, taking more liquid supply off the market.
And it's not just financial institutions, right? You mentioned corporations getting involved, too.
Yeah, that's another huge trend. Michael Saylor's company, Strategy, is the prime example. They basically pivoted their whole business model to accumulating Bitcoin. It's their main strategy now. As of mid-2025, they held over 2.75% of the entire Bitcoin supply. That's around 582,000 Bitcoin.
2.75%, held by one public company.
Yeah, and get this, it means Strategy holds about 3% of all the Bitcoin that will ever exist. They're #1 on the public company list by a mile. Their stash is almost 12 times bigger than the next public holder, Marathon Digital. It's quite something. Since they started buying in August 2020, Bitcoin's price is up like 700%, and Strategy stock up 2,500%.
Incredible. So they're not alone, though.
No, definitely not. We saw Trump Media and Technology Group talk about a huge fundraising round to buy Bitcoin. GameStop revealed a $500 million Bitcoin investment. There's even a new company, 21, that launched specifically focused on Bitcoin, starting with over 42,000 BTC on its balance sheet, making it the third largest corporate holder globally right out of the gate. What's really telling is, by mid-2025, one survey found about 59% of institutional investors had put at least 10% of their portfolios into Bitcoin or other digital assets.
59% allocating 10% or more?
Right. It signals this big shift. It's moving from just being a speculative bet to, a core part of serious investment portfolios.
Okay, but with so much Bitcoin ending up in fewer hands, these big institutions, these whales like Strategy, it does raise a question, doesn't it? Does this kind of concentration clash with Bitcoin's original idea of being decentralized?
That's a really important discussion. And yeah, there are definitely strong opinions on both sides. Critics look at the numbers like the top 100 Bitcoin addresses holding about 15% of the supply, or addresses with over 10,000 BTC controlling 14%, and they warn, look, this could challenge decentralization. They worry power might be getting too concentrated.
Makes sense. What's the other side of the argument?
Well, the counter-argument is that this shows massive confidence in Bitcoin. Proponents say these big holders, these whales, they aren't just trying to make a quick buck by flipping coins. They're holding for the long term, which signals deep belief in Bitcoin's future value. It actually stabilizes the asset, they might argue. So it leaves an important question for you, the listener. How do you balance the clear benefits of institutional adoption against these concerns about concentration? It's not a simple answer.
Right. So let's tie this all together. We have the fixed supply, the halving reducing new coins, loads of existing coins being held tight and not moving, and then this massive institutional demand piling in. What does it all mean for the supply shock people are talking about? Is it like one day Bitcoin just runs out, or is it more gradual?
Yeah, it's crucial to understand it's not like Bitcoin will vanish overnight. You'll still be able to buy it. But the usable, easily tradable supply, that might really dry up. What we're likely seeing is that the supply shock isn't a single event. It's already happening, just kind of in slow motion. You could call it a slow-burning Bitcoin supply squeeze.
A slow burn.
Yeah. Pressure building from all sides. Miners earn less new BTC. Institutions vacuum up more and lock it away. Long-term holders refuse to sell. It all adds up. The real trigger for a big price spike, though, that comes down to new demand. If regular investors, more corporations, maybe even some countries keep deciding they need Bitcoin, well, with such limited supply available to buy, you can easily get this feedback loop. Rising prices pull in more buyers, which pushes prices higher, and so on. As Michael Saylor puts it, over the long term, Bitcoin on the balance sheet has proven to be extraordinarily popular. He's betting on that demand continuing.
Okay, so that's the core Bitcoin mechanics. But are there bigger, macroeconomic things influencing this too? How does the wider world situation fit in?
Oh, absolutely. The macro environment is always a factor. Right now, we still have relatively high interest rates globally, which can sometimes make risky assets less attractive. Governments are also still pretty cautious. There's ongoing regulatory uncertainty. Plus those ESG concerns, environmental, social governance, they haven't gone away. And let's not forget gold. It's still the king of traditional stores of value for central banks. They bought over 1,000 tons of gold just in 2024 for their reserves.
So connecting those dots, is Bitcoin likely to knock gold off its perch anytime soon?
Probably not yet. Gold has centuries of history and deep institutional trust. But 2025 is really the first time in history where you can say Bitcoin's scarcity profile is objectively tighter than gold's. If supply dynamics are getting more aggressive, its adoption story is broadening rapidly. That comparison, Bitcoin versus gold, is becoming much more interesting. It's a significant shift.
So wrapping this up, we've really seen how Bitcoin's built-in scarcity is being put to the test right now, in real time. You've got the hard cap, the halving cutting new supply, huge amounts of institutional and corporate money coming in and locking up coins. And then this ongoing debate about concentration versus confidence. It all points to one clear thing. There's just less Bitcoin easily available to buy. Whether you see that as a super bullish supply shock coming or maybe a worrying trend towards centralization, the underlying forces are, well, they're pretty undeniable.
Absolutely. Anyone involved, investors, regulators, even just casual users, really ought to be watching this space very closely. If Saylor and the other big players keep buying, if demand from new sources keeps growing, then the question isn't really if there's a supply shock happening. It's more like how high could the price actually go when the full force of that demand hits the increasingly scarce supply. It really encourages you, the listener, to think about these powerful forces, supply, demand, technology, human psychology, and how they're shaping not just Bitcoin, but maybe the future of digital assets altogether. It's a fascinating intersection to watch.